There will be no quick video editing or flashy edits here, only useful practical information. And remember, the last point that we will consider is the most important. Enjoy the video. At first glance, both indexes may seem similar, but they actually tell you different stories about the US stock market. Knowing which one to follow can help you understand market trends, investor sentiment, and where the biggest opportunities or risks may be showing up. The S&P 500 is often seen as the broad measure of the US market because it includes 500 of the largest public companies across many industries. That means it gives you a wide view of how big American businesses are performing overall. The Nasdaq, on the other hand, is much more concentrated in technology and growth companies. That makes it more sensitive to innovation, interest rates, and investor enthusiasm for fast-growing businesses. So if you want a picture of the whole market, the S&P 500 is usually the better benchmark. If you want to understand the mood around tech stocks and growth names, the Nasdaq is often the more useful one. One big reason people track the S&P 500 is diversification. Because it includes companies from many sectors, it can be a more balanced snapshot of the economy. You will find technology, healthcare, financials, industrials, consumer brands, and more all inside the same index. That makes the S&P 500 a strong reference point when you want to know how the market as a whole is doing. The Nasdaq is different because it leans much more heavily toward technology and innovation-driven companies. That includes names in software, chips, internet platforms, electric vehicles, and biotech. When tech is leading, the Nasdaq may outperform the S&P 500. When tech falls out of favor, the Nasdaq can drop faster and farther than the broader market. Another important difference is volatility. The S&P 500 is usually less volatile because it is spread across more industries. The Nasdaq can be more dramatic because so many of its largest companies are tied to growth expectations. That means the Nasdaq often reacts more sharply to changes in interest rates, earnings forecasts, and economic news. If investors expect rates to fall, growth stocks often look more attractive, and the Nasdaq can surge. If rates stay high, those same growth stocks may struggle, and the Nasdaq can feel extra pressure. The S&P 500 is also useful because many investors and fund managers use it as the standard for measuring performance. If a portfolio beats the S&P 500, that usually means it has done well relative to the broad market. For that reason, it is one of the most important benchmarks in American investing. The Nasdaq, meanwhile, is often used as a signal of how the market feels about innovation and future growth. If the Nasdaq is strong, investors may be willing to take more risk and pay higher prices for growth. If the Nasdaq is weak, it can be a warning that investors are becoming more cautious. So which one should you track? If you are a long-term investor who wants a broad, stable view of the US economy, the S&P 500 is probably the better index to watch first. If you are more interested in technology, high-growth stocks, or market momentum, the Nasdaq may give you more useful insight. Many investors actually watch both because they reveal different parts of the same story. The S&P 500 tells you how the overall market is doing, while the Nasdaq tells you how the growth side of the market is behaving. That combination can help you see whether strength is broad or concentrated in just a few areas. If both indexes are rising together, that usually suggests a healthier market environment. If the Nasdaq is rising while the S&P 500 is flat, the market may be leaning heavily on tech leadership. If the S&P 500 is holding up while the Nasdaq is weak, that may mean investors are rotating out of growth and into more defensive sectors. In other words, the relationship between the two indexes can tell you a lot about market leadership. So the smartest approach is not to choose one forever and ignore the other. It is to understand what each one is designed to show and use them together when possible. The S&P 500 gives you the big picture, and the Nasdaq gives you the growth picture. If you watched until the end, you now know that the best index to track depends on whether you want a broad market view or a closer look at the tech-driven side of the market.